Hi, everyone. This is Jason Burek of Wall Street for Main Street. Welcome back to another Wall Street for Main Street podcast interview. Today's special guest is a returning guest. He is an oil market expert. He has been a geological consultant with 37 years of experience in petroleum exploration and production. He was also an early investor in many shale wells. So he's actually profited from shale wells in the past, and we could talk about perhaps the changing economics of some of these shale producers. Art Berman, thank you for joining me again.
Pleasure to be with you, Jason.
Now, Art, before we get into some of the bottom-up analysis of the shale market and some of the producers, I want to get your opinion on the 30,000-foot view of the oil market supply-demand fundamentals. So I think there's a lot of economic data out there that the global economy is slowing down. Do you think that this slowdown in the global economy has had any meaningful impact on the supply-demand fundamentals of oil?
Yeah, that's it's a little bit hard to say. My sense is no, not yet. I mean, we've been in a situation for, I don't know, at least a year or two where all the forecasts have been that world demand is, is slowly decreasing. At the same time, we're really not seeing a lot of hard evidence to that effect. And so some of this has to do with what I consider to be sort of exaggerated, maybe fearful, maybe hopeful expectations that somehow the world is making a rapid transfer away from oil and gas and coal, and in no time at all, we're all going to be driving electric vehicles, and the world is going to run off of solar and wind. I mean, that's all, a very nice vision of the future. And by the way, I mean, I certainly support all forms of energy. Renewable, so-called energy, I think is just lovely. But at the same time, I don't see any reasonable physical way of getting off of oil and gas and coal anytime in the next many decades, no matter how much everybody wants to, and maybe even how much we have to. So again, that's not a partisan statement. That's just my sense of how quickly human beings and their societies are able to adopt new forms of energy. These things take a really, really long time. In fact, humans change very slowly. So back to your question, it seems like global demand is a little bit lower right now than it was the last couple of years. But bear in mind that, we're coming off of some of the lowest oil prices in real dollars in the last 10 or 15 years. And if you look back 30 years, 40 years, the average demand growth for oil is about 1.1 million barrels a day over that whole period. And all these supposedly gloomy forecasts about 2019, 2020 are 1.1, 1.2 million barrels a day. Think about it. We're not talking about use of oil going down. We're talking about demand growth slowing a little bit, maybe. So, again, I just want to keep that in context, because people, they believe what they read, and they start thinking that everything is changing very quickly, and the truth is that nothing changes very quickly, certainly when it comes to the primary energy source of the planet and all of our civilizations. So having said that, yes, it does appear that demand is a little bit slower right now, a little bit lower demand growth, that is, than it was when oil prices were a lot lower. And I think that stands to reason that if things cost a little bit more, people put the brakes on a little bit more about using them. But back to your initial question, the time lag between a global slowdown, which I think is questionable. I'm not saying it isn't happening, but I mean, again, there isn't any overwhelming data that says that the world is in a recession. But it takes a long time for that to all lag back and trickle down to the world of energy. And I say that because, I mean, those of us who, most of us, our most immediate contact with the oil industry is when we go to the gas station and put gas in our car. And so if the price of gasoline is, $4 or $5 a gallon, I don't know about you, but I mean, I'm going to think twice about, gee, do I really want to drive this much? But we're nowhere near that. I mean, gasoline is, something like $1.75 a gallon. I mean, it's really cheap historically right now. So, I just don't really see that this is anything more than, people freaking out about what may happen. The other thing I'll mention before I, finish this little discursive answer to a simple question is that an awful lot of energy use, diesel in particular, is quite inelastic. I mean, trains are going to run, ships are going to run, trucks are going to run, almost no matter what the price of diesel is. I mean, when the major transportation system of the world, not talking about, you and me driving to, out of town 40 or 50 miles to go visit friends, I mean, it takes orders dropping way, way off before trains and ships and trucks start cutting back on their use of diesel. So, again, just kind of trying to put a context around the question that you're asking, Jason.
Okay, so just to add to some of your points there, I agree with pretty much everything you said there, except for the global macro data, like the export data out of Germany, South Korea, Taiwan, Japan. It's been slowing down a lot lately. So I think that's saying that if we haven't hit an official recession soon, we will. So the export data out of those main export powerhouses in South Korea, 50% of their economy is exports, and that data is down a lot. But the Saudis and OPEC just released a report saying they expect demand to slightly decrease. And then recently, with oil prices are down, WTI is down 3.36% today, down $1.86 per barrel at $53.49. And the rig count plunges to near a 2-year low, but the U.S. oil production is holding steady around 12.3 million barrels per day. So the production levels are still high. Do you think at current WTI prices, I know Shale is discounted to WTI, and you can tell my listeners then how much of a discount shale oil is to WTI, but is a lot of the shale oil production in the U.S. is producing a record amount of it. Is it economic at current oil prices? Is almost all of it economic, or are these producers like treading water, breaking even, or some of them losing money?
Well, let's back up first of all. There is no difference between, first of all, there's no such thing as shale oil. I know what you mean, Jason. It's oil produced from various reservoirs that fall shale, although that's not really true. But nonetheless, WTI is the oil that comes from shale. It's the oil that comes from everywhere in the United States. There's no distinction. There is no difference between, the oil. I mean, the oil that's produced in the Permian Basin is WTI. The oil that's produced in the Bakken is WTI. It's all WTI. So WTI is a basket. It's a spectrum. And what I can say definitively is that the oil that comes out of these shale plays, so to speak, is on the light end of WTI, but it's very much WTI. So the discounts that you're talking about, let's say the Bakken in North Dakota, it costs about $7 a barrel to ship Bakken oil by rail to Cushing, Oklahoma. So the price that someone is going to give a producer at the wellhead is discounted, but not because there's something wrong with the oil, it's discounted because he's going to have to pay $7 to get it someplace where he can sell it. So, that, and similarly, in the Permian Basin, there really isn't enough pipeline capacity to take the oil away. So there's all these producers clamoring for takeaway, and the pipelines say, "Hey guys, we'll give you a terrible deal. We'll move your oil for $4 or $5 less than it's worth." And the producers say, "Well, that doesn't sound fair." And the pipeline says, "Well, take it or leave it. We got more oil than we can move. So our deal is we're going to offer you less because it's a buyer's market." So, so that needs to be understood. Yes, the oil that comes from these plays is lighter. Most of the oil produced in the United States is quite light, and that is an issue and that is a problem that I'm glad to discuss with you. Let me just correct something you said at the beginning. I've never invested in a shale well in my life, nor would I. And I do actually hold a little bit of stock in EOG, which is a company that produces from a lot of these tight oil plays. But in fact, I would never put any of my money into any oil or gas well because it's too risky. But that's not investment advice. That's just the honest truth from someone who's been in the business his whole life. But your question, the more important part of your question, I think, is: are these plays, the Permian Basin, the Eagle Ford Shale, the Bakken Shale, are they commercial? The answer is, well, it depends on what the oil price is today. Now, you mentioned that WTI is down several bucks today. That's got nothing to do with anything we're talking about. That's Donald Trump. I mean, the stock market's down 500 points today, and these things tend to move somewhat in tandem. So Trump is causing his usual, and again, this is not a political statement, this is objective fact. Trump is rattling world markets today by suggesting that all companies find places other than China to do business. So investors are freaking out, and they're fleeing from everything, not just oil. So today's drop in WTI got nothing in the world to do with any kind of supply-demand issue, okay? And back to your comment, yeah, I pay attention to export data out of various countries, but there's an awful lot of economists that would say, well, that's not good news, but we're not in a recession. And again, I'm not an economist, so I'm not arguing with you. I'm just saying that it's not obvious to experts that we're in a recession. I happen to think that things are looking badly, as you do, Jason. But my whole point is it takes some time. It takes months and months and months of a really bad economy to start to have an effect on demand for oil. So we're not there. By whatever your opinion is on where the world economy is going, we're not there. Even when the economy crashed in 2008, it took 6 months before production rates stopped going up because there's a huge lag. Capital expenses are, the money gets committed, the wells are drilled anyway. So, I think it's a mistake to assume that, that there's a very tightly controlled cause and effect relationship between the economy and oil markets. The world runs on oil. And for the world to stop using oil, things have got to get really, really bad or slow down its use of oil. So that's my take on that. The shale plays, as they're called, again, the Permian, the Bakken, and the Eagle Ford, the break-even prices on these plays are about $60 a barrel. Okay, and I can get into a lot of detail why that's true, but that's information that I get straight from the companies, right from their annual SEC filings, where they're required to put a number on their future cash flows from proved reserves, and it's not really all that difficult to back out from that what their cost per barrel is, and I've done it. And it's $60 a barrel on average for these companies. So you could say, well, that's the bad news, because these companies have been promoting the fact that they're making money at $40 a barrel. Well, not really. I mean, they're being misleading. You got to ask, well, what's $40? What cost does that include and exclude? Oh, well, that's just production costs. Oh, so in other words, that doesn't include the cost of drilling a well. Right. Oh, okay. Well, that's great. What use is that? So when you include all these costs, it's about $60 a barrel. And I've said that for as long as I can remember, based on taking it from the bottom up, from the wellhead, looking at the reserves, and what are all the costs that go in, and working up to a number. And I'm telling you that I just went through the 2018 10K filings by these companies, start from the top, work down. This is their data, not mine. No interpretation involved. It's $60. So keep that as a benchmark.
That's some good analysis, Art, and that's a big discrepancy between some of these investors' presentations, because only a couple months ago, some of these shale companies were doing investment bank and hedge fund conferences, and they were telling the investors there that their production costs were $20 to $30 a barrel. And like you said, I think that's leaving out a lot of their costs. I think I've spoken to other people that are always bullish oil, always bullish to the shale companies, and they've told me out of Houston that these analysts, they've worked in the oil industry a long time like you, and they tell me straight up that their production costs are $20 to $30 per barrel. And I was like, isn't that just lifting costs? That has to be leaving out like selling, general, and administrative expenses, cost of capital, transportation costs. I mean, it sounds like, because the cost numbers are not matching the financial statement.
So let me give you an analogy, back to going to the gas station. So if I tell you that, my car gets, 30 miles to the gallon, and, and a gallon of gasoline costs $3, then, I get 300 miles on a gallon of gasoline, so it costs me $30 to drive 100 miles. Okay, well, that's great. But what about paying for the car? What about paying for the insurance on the car? What about paying for licensing and registration? Oh, whoops. Okay, so I have to pay $400 a month, on my car loan. Well, we're not counting that. We're just telling you what it costs to drive my car. And so production costs are, as you said, those are just the costs of physically producing the oil. That's not anywhere near all the costs that a company has, even excluding the cost of drilling the well. So those are bogus numbers, or let's put it this way: they're misleading numbers, and there are reasons for presenting it that way, and the reasons are that you want to be able to compare different companies. So let's just say, for example, company A has $5 billion in debt, and company B has zero debt. And so company A has to pay a whole lot of money every month in debt service, and company B pays zero. So if you include all your interest expenses and cost per barrel, then company A is going to look really bad and company B is going to look really good. But it could be that company A has much better wells than company B. So by including that interest expense, you're skewing an understanding of how good is their underlying asset. That's not to say that you shouldn't look at that. But if all we're trying to do is compare company A and company B in terms of how efficient they are at operating in the field and how good their wells are, then you don't want to take those things into consideration, at least for that analysis. You add them back in as you put the whole story together.
Okay, so I think I understand the point that you're getting at, but it's just, still the average person is not going to do the research that you're doing. So the average person is going to maybe go to the company website, maybe look at the investor's presentation, the PowerPoint slide deck, which are not the real numbers that the company files with the SEC. And for some of these shale companies, there was a book by Bethany McLean called Saudi America, where not all these shale companies, but some of these shale companies were dramatically overstating their reserves by 8 to 10-fold, comparing their investors' presentation, their annual reports versus their SEC filings. And I think isn't there a lot of class action lawsuits by pension funds, because the pension funds have invested a lot in shale oil since 2007 in junk bond debt and also equity shares.
Well, again, Jason, what did I say 15 minutes ago? I said I've never invested a dime in an oil well. And I only own one energy stock. That's because I know a lot about the oil and gas business. Now, I'm not saying that that you or your listeners shouldn't invest in oil and gas. I'm just saying if you're going to invest in oil and gas, whether it be in stock or in a corporate bond or in a well, you better get somebody who can advise you on that, who knows the kinds of things that I know. Because otherwise, you're going to make the same kind of mistakes that you will investing in anything that you don't know enough about. So investor beware. Now, as far as pension funds and all of that, whether or not they're suing these companies, what are they suing them over? Are they suing them over misrepresenting their reserves? I have not heard of very many cases like that. I have heard of a few, but those are in very specific cases of funds, where a company is going to sell forward its production, and it's a very specific kind of a thing. It's not you're buying stock in that company. And so I don't want to give the impression that if a company books reserves with the SEC, that it's truth, but it can't be grossly wrong, or else somebody's going to go to jail. So I don't agree that the reserves booked by all these companies are they don't necessarily agree with my assessments of the reserves, but I don't think that there's some kind of massive fraud going on here. If you understand what the SEC rules are, you'll real quickly understand that there's kind of a pretty squishy definition of what some of these reserves, how they're computed. And again, you better know about that before you put your money in it. And if you don't know about it, you better get yourself an advisor, someone like me, to tell you about it. Again, I'm not giving investment advice, but you find someone, as you would with any investment, who knows more than you do, who can give you that kind of information and background. What's the risk?
Yeah, I think technically it's not illegal because they are filing accurate information with the SEC. But then if someone doesn't know that the information may be different from one, it's like a piece of marketing, that the information of marketing on a company website may be different than the information with the SEC, then technically it's not illegal, and it's the problem of the person who's making the investment to have done the research. So they need to learn to.
And if you look at a slide that shows what you're saying is a discrepancy, somewhere in that slide is an asterisk that leads to someplace else in the presentation, to an appendix. And if you go back, this is the fine print. And so somewhere in there is a disclaimer saying, oh, well, when we say this, it only applies to 15 wells in, the northeast corner of thus and such a county. And, even though it kind of sounds like we said it's all our wells, it's not really. It's just a handful of wells. And I think that is often the case, that I have not seen a lot of situations where the companies are just lying about their reserves. It's that the investor is not sophisticated enough to understand that they're not talking about all their reserves. They're talking about some subset. They're cherry picking the number, and buyer beware. It's like any investment. You can get fooled, and you can get scammed, or you can just be ignorant and make mistakes. So get some advice. I'm not saying you have to use me. There's a lot of people to use, but get someone who knows how to navigate the ins and outs of everything that we're talking about here this afternoon.
Well, Art, all I hear on the mainstream television, on the mainstream media, and mainstream financial media is I hear repeating that the U.S. is an energy-producing powerhouse, that the U.S. has enormous oil reserves. And you've written articles on shale for the last few years now that the reserves, especially I think in the Permian and elsewhere, are overstated.
Well, again, overstated by whom? I mean, the perception that you get from reading the mainstream media is that that the United, as you said earlier, that the United States is approaching or equal to Saudi Arabia or something. So we're talking, roughly 250 billion barrels of reserves. Well, that's bogus. And if you go and look on the EIA, the Department of Energy's website, you can very quickly find, well, what are the reserves of the Permian Basin? And the tight oil production, what we're talking about, these so-called shale plays, it's like 7 billion barrels. So, I mean, it's certainly not nothing. I mean, that's a big number, but it isn't anywhere near Saudi Arabia. I mean, there's just no way. And so, I mean, this is publicly available information. You don't have to, you don't have to be, you don't have to have a green shade on over your eyes to be able to go to the EIA website and type in reserves and find it. Or, you call somebody like me and I'll tell you. So, no, I don't think the reserves are, grossly overstated. I mean, the United States has roughly 50 billion barrels of proved reserves. I mean, that's the number. And, that's something like a quarter or even less of Saudi Arabia. So the United States is and always has been, if you want to use the word, a powerhouse. I mean, the United States has been the first, second, or third biggest producer of oil in the world since 1859, for crying out loud. We've always been a big producer. The United States is very rich in natural resources. But we also import 7 million barrels of crude oil a day. Well, why is that? Well, because we use a lot of oil. I mean, it's just real simple. There's nothing wrong with that. It's just we use more oil than we produce. So, again, be careful. I mean, the impression you get is that we don't need Saudi Arabia, we don't need Iraq, we don't need anybody. We're completely energy self-sufficient. Well, I mean, that's a ridiculous statement. If we're importing 7 million barrels of oil every day, then by definition we are not energy independent. Period. I mean, go no further. We're very dependent. We are less dependent today than we were 20 years ago. That's good news. Bad news is we import more oil than all of Europe put together. So, equal population. So there you go.
Yeah, something else about the shale oil industry compared to maybe other oil wells. I think it was one of the independents, the mid-tier oil producers, it might have been Hess Oil or one of those, said that they were looking at growing oil production by 200,000 barrels per day, and they were weighing the CapEx cost versus increasing shale oil production by 200,000 barrels per day, that it was around $12 billion of CapEx now to drill all the wells necessary, and they were weighing the CapEx versus how much to grow their oil production, the same amount deepwater offshore. And I think now for the first time in a number of years, the CapEx for shale to grow production by 200,000 oil wells per day is now substantially higher than the CapEx to grow oil production the same amount for deepwater offshore.
Yeah, I don't believe that, but okay. I think that all of these, whether you're talking deepwater, in my world, deepwater is unconventional in the same way that tight oil is, and that is, you're drilling in 6,000, 7,000, 8,000 feet of water. You're producing hundreds of miles offshore. I mean, it might be, everyday regular crude oil, but everything about that operation is super duper expensive and high risk, and so it's unconventional by my definition. And so I do not believe that. I think $60 a barrel is kind of the basic cost of producing any any meaningful volume of oil anywhere in the world today. I don't care if it's in the deepwater Gulf of Mexico, if it's in the Permian Basin, if it's in Saudi Arabia. I don't care where it is. I mean, that is the basic marginal cost of a barrel of oil anywhere in the world today. Now, it didn't always used to cost that much. I mean, a lot of, the major oil companies, including Saudi Aramco, I mean, they used to be able to go out and find and produce the stuff for a lot cheaper. I mean, those were in the days of abundance. But, you actually, if you put an inflation factor, or consumer price index factor on the oil, you find out that, oil has never cost more than, like $30, less than $30 a barrel in today's money. But what we found is that around 2000, we started running out of the relatively easier to find, easier to produce, cheaper to produce oil, and the cost of everything started going up. So, yeah, it's true. If you got an old field out there, you could probably maybe full in cost to produce it and work out to be $40 a barrel. And if you go out and drill, discover a new field, whether it be in a shale play or the offshore or whatever, it's going to cost you more. And that's in fact one of the leading reasons for the economic malaise that we see in the world today. That for all the enthusiastic news about the U.S. economy and et cetera, I mean, go on the St. Louis Federal Reserve's website and look at their M2 money supply. The ratio of GDP to money supply. And what you see is that for the United States, it peaked in 1998, and it's had some ups and downs in between, but the overall trend is down. It went up a little bit before 2008 with the financial crisis. It went way down, came back. Basically, the trend is down, and one of the main reasons for that is the cost of energy. Any kind of energy has been going up and up and up. And if your underlying cost has gone up by a factor of 50 or 60%, which is the difference between what a barrel of oil cost in 2000 versus today in July 2019 dollars, then I don't know too many businesses in the world that are able to absorb a 50% increase in the cost of doing business and still be able to make big profits. Okay, so that's what we're dealing with, and a lot of the populism that's going on in the world, not just in the United States with Trump, but in Great Britain and Brazil. I mean, not suddenly, but all of the working class people in the world have come to the conclusion, hey, we're getting screwed here, guys. We haven't had any kind of real income growth in 20, 30 years. And, and that's true. And they're blaming various classes or political elites or whatever, and therefore they're reverting to populist leaders. That's, again, not a political statement, and I'm not saying if that's a good thing or a bad thing, but all the unrest in the world, most of it, is reflecting this underlying fact that things are not getting better. Things are kind of slowly getting worse, and people are unhappy about that because it makes their lives more difficult. And underlying all of that is the fact that the cost of oil is getting higher. So back to your point, there may be a particular field in the deepwater Gulf of Mexico that Chevron or Exxon or Occidental or Hess or whatever says has better economics than their position in the Permian Basin or the Bakken. But, there's a company right next door that has a better position in the Bakken or the Permian and a worse position in the Gulf of Mexico, and they're going to tell you the opposite. So you got to be careful.
Yeah, Art, I think an overarching theme, and you described it, is that the oil industry is dealing with higher cost oil and then also having to deal with too much debt. I think the oil industry, there used to be a saying I used to hear about the oil industry that you don't drill on debt. But that saying seems to have gone by the wayside. It seems to have changed a lot, that the balance sheets of a lot of these oil producers has a lot of debt, whether it's ExxonMobil using a lot of debt for share buyback or the shale producers that issued a lot of junk bonds.
Back in the days when I worked for a major oil company back in the 1980s and 1990s, we were, a AAA bond-rated company, and our rule of thumb was that you wanted your debt to equity to be no more than about 30%. So there's always been debt in the oil business, but you had a gold-plated credit rating if your debt to equity ratio was 30%. That's gone away, and but it's again because of everything that I'm talking about, and it's not just oil companies; it's countries. I mean, the United States didn't used to have $20 trillion of sovereign debt, but it does now, and a lot of that is because of, as I say, the cost of energy, that it underlies everything we do. I mean, and let's just talk for a second about solar panels or wind turbines or whatever, because it's energy, and I know a little bit more about that than I do some other economic factors. But, you hear all the time, I do, that, the price of wind and solar is, it's actually cheaper than natural gas. I mean, that's the biggest bunch of crap in the whole world. I mean, that's just a lie, okay? It is. And again, that's not a partisan statement. It's sort of like saying our cost of producing oil is $20 a barrel. Tell me what costs are included and excluded in what you just said. And so there isn't a solar panel in the world that can be made without mining all kinds of minerals, including metal and stuff. All that's done with diesel, okay? All that metal and minerals has to be shipped somewhere to be manufactured. That's all done with diesel. That's done on ships. You go to a factory, whether it's in China, whether it's in the United States, what's the factory run on? It doesn't run on sun. It doesn't run on wind. It runs probably on electricity. Where's the electricity come from? Mostly natural gas and coal. You make the solar panel, and then you have to ship it from somewhere to somewhere else. You got to ship it from China to the United States. How do you do that? You put it on a boat, and you send it by diesel. You get it to Los Angeles, then what happens to it? You put it on a truck, and the truck takes it to wherever it's going, again, using diesel. All right, so when you finally get the solar panel out there to the end user, you've got a huge value chain of oil, gas, and natural coal, without which the solar panel could never exist. And people like to omit that from the story because it makes for a crummier story. But that is the reality. And again, I'm all for renewable energy, all for it. I'm not trying to say anything negative about solar panels or wind turbines. I'm just saying
they're also not efficient.
Everything that sounds too good to be true probably is, whether it's oil, whether it's wind, whether it's solar, whether it's tulips in Denmark, whether it's .coms, they all are too good to be true, and they're not true. So
and
beware.
Most of to add your points there, they're also not efficient yet. Most of the solar panel companies I've seen, they only last at most 10 years, and some of them have to be replaced a lot more quickly than just 10 years. So some of them,
Absolutely.
You're replacing all.
Well, yeah. I mean, my friend Nate Hagens, who's a real expert on this, he says renewable energy is an absolute misnomer. It should be called rebuildable energy. And he's an ecologist. I mean, this is a guy who wants to save the planet. So, I mean, he's not an oil company guy at all. But it's rebuildable energy. So, even the words we use are, they give the wrong impression. These are not renewable. There's nothing renewable about a solar panel, as you say. But back to the whole line of questioning and discussion we're in, the level of information that makes for a good news story is typically superficial. And when you dig down into it and actually find out the truth is different. And as with anything, you're making a choice between two things, and somebody says, well, this thing is just as good and it costs, 10% of this thing. Well, okay, you go buy the 10% thing, and you usually find out that it, in fact, didn't turn out to be very good. Doesn't mean that the most expensive thing is necessarily any better than the second most expensive thing, but you get what you pay for. So whenever anybody tells me, that anything in the world is so much cheaper than something else, that I can get my electricity from a solar panel at a fraction of the cost of what I can from a gas-fired electric power plant, I don't believe it. Right off the bat, I just say I don't believe that, because that's not the way the real world works.
I think it depends which political party is in power, because if during the Obama administration, a lot of capital from the Department of Energy and other programs and subsidies and tax credits were thrown at the renewables. So, when the Democrats are controlling the White House and when they're controlling, they have a majority, a two-thirds majority of both houses of Congress, they tend to want to subsidize a lot of this stuff, and then the Republicans tend to be more pro-oil, generally speaking.
Well, I don't think Trump's pro-oil at all. I think he hates oil.
Oh, really?
In fact,
that's interesting.
Oh, go look at his past. And, he has single-handedly scared away more capital from the oil industry than any single factor in my lifetime. And if you look at, and again, this is not political at all. This is just factual. That when Donald Trump decided to renege on the sanctions against Iran's oil exports in October of last year, what happened? The oil market collapsed. Oil prices crashed, and if you look at the futures market, the commitment of traders. The open interest on Brent, on WTI, is a fraction of what it was in September, October of 2018, because investors, and I'm talking institutional investors, hedge funds, managed money, pension funds, they're saying, forget it. This guy screwed us so badly. We lost so many tens of billions of dollars because all our investments were geared toward, okay, Iran is going to disappear partially, if not completely, as a source of oil, and all our investments are based on that. And then one day he said, oh, never mind. We're going to grant waivers to this country, that country, the other. And it did irreparable damage to investor confidence in oil.
Didn't Trump also... Didn't Trump, or was this Congress, didn't he also get the tax laws changed for the master limited partnerships? So now the master limited partnerships, which are oil and gas pipeline companies, also, I think most of the upstream MLP producers have already gone bankrupt, but the pipeline companies now, the MLPs, are in serious jeopardy. They have to restructure their corporations from MLPs, I think, to C corporations, because they're not going to get the same tax benefits that they did for since the 1980s, I think.
Well, the MLP, what MLPs are we talking about? There's a million, but if we're talking about pipelines, MLPs got into a lot of trouble after oil prices collapsed in 2014 because the basis of their business is on commitments from producers, that a producer commits to send a certain volume through a pipeline, and that's the way that their revenue stream works. And a lot of companies defaulted on those commitments because they couldn't afford to produce the oil. And so the MLPs took a big hit there. As far as how the tax laws, somehow disadvantaged the MLPs, you probably know more about that than I do. But My point, on a much more macro scale, is everything that Trump does. He calls Saudi Arabia and tells them to produce more. That drives down the cost of oil. I mean, I'm sorry, based on just facts. Anybody who thinks that he's a friend of the oil business needs to look at facts. He's not a friend. He loves natural gas. He's big
and
on
coal.
LNG. Well, he says he loves coal, but he doesn't do anything for the coal miners because there's nothing you can do for them. That industry was in the tank long before Donald Trump even thought about running for president. I mean, employment in the coal industry has been in steady decline since the middle of the last century, and those are secular trends that just aren't going to change. And even if he is successful at resuscitating the overall coal industry, most of that mining is going to be done with machines. It's not going to be done with human beings. So, that's kind of that's a red herring, I think. But nonetheless, the point being, I don't think you can characterize and say that, this particular Republican administration is like all others and that they favor oil, because there's I can't name one thing that's happened since Trump became president that was in any way positive for oil. Gas?
That's That's really interesting, Art, because I've never heard anyone else say that. So all the coverage in the mainstream seems to be that, Trump, everyone paints Trump as, he's in favor of oil. That's all the mainstream media coverage. So it's interesting hearing from someone inside the oil industry who's worked there as long as you have that, that's not really the case, because all the mainstream coverage, like I said, is that Trump is bending over backwards to help the oil companies.
Well, go and, the CFTC, the Futures Trading Commission, they're publishing, they have published today the commitment of traders for, the week ending last Friday. Go look at it. Go look at open interest. How many contracts are out there on WTI? And compare it to what they were in October of last year, and you will see, you'll go, whoa, what happened? What happened? Well, what happened is everybody said, forget it. We can't deal with this kind of risk. It's a risky enough bet as it is, and we got a guy who just overnight, with nobody's advice or consent, says, oh, never mind. Everything you guys have been planning for the last 6 months, never mind. I mean, that has real significant consequences. I'm not saying it's wrong or right. I'm just telling you what the reaction has been.
So it sounds like the people in the oil industry have had to do a very difficult 180.
Well, they're having a really hard time raising money, and a big reason for that. There are many reasons for that, but one of the primary reasons is nobody wants to touch the oil business because of what happened based on an executive decision 8 or 9 months ago.
So there's been 28 bankruptcies of oil producers, according to a oil industry law firm so far in 2019. I mean, it's not a record yet. We're not to the levels of 2014, anywhere near those levels. We are more than the total amount from last year, 2018, and the year before, 2017. Would you expect that to continue then if oil prices go lower?
Well, yeah, but but so what? I mean, let's talk about 2016. We had an absolute record number of bankruptcies in the oil and gas business, and that was because the price of oil had collapsed. I mean, we were looking at $27 a barrel WTI in February of 2016. Well, what happened as a result? I mean, did Joe Q. Public feel a big difference in the U.S. economy? I didn't. Did you? No, nobody did. Most of those companies are in business again today. Maybe they have a different name. Most of the same guys that drove them into bankruptcy or managed them into bankruptcy have their same jobs at a higher salary. I mean, bankruptcy doesn't necessarily mean the end of life as we know it. It's a way to discharge your debt is what it is. I mean, that's what it's always meant. So, no, I don't spend a lot of time. I didn't spend a lot of time in 2016 worrying about bankruptcies because while it's unfortunate and it's sad and it's particularly for the employees who work for those companies who have to find new jobs, it's a drop in the bucket as far as the overall economy and as far as the overall oil industry. I mean, there are guys out there on the internet, that are constantly talking about how, all this shale is a Ponzi scheme, which it absolutely isn't, and I'm in no way endorsing the ethics of the industry by saying that. Ponzi scheme is very, very specific. That says that I get money from an investor and I give it to the next one, that I don't put any money in my company. Whatever you want to say about tight oil companies, they are absolutely not Ponzi schemes. But there are guys out there, that are guys on my Twitter feed, are posting crap, and I tell them, don't post this. Post it on your own Twitter feed. Don't put it on mine. Trying to make people afraid that the whole U.S. oil industry is going to implode and it's going to pull the whole United States economy into a big depression. That's absolute crap. People who say that, I can't tell you why they say that, and nor am I saying that things couldn't get bad for the oil business, and they have been before. But, the oil business is just not that big of a piece of the U.S. economy to do that. And you're assuming that every single company goes bankrupt at the same time, and that never happens. And, oh, by the way, energy is kind of important to the United States. In the unlikely event that something terrible like that happens, what did we do for General Motors? We bailed them out, right? So I just think, again, you got to be really careful. This is sensationalism. This is, I don't want to say it's fake news, but it's put out there by people that don't really either understand what they're talking about or have a vested interest in promoting something that's untrue, whether they get clicks or advertising or investments, I don't know. But honestly, I'm not trying to paint a rosy picture for the oil business because it is serious, but I don't spend a lot of time worrying about, the industry going belly up. I don't see it.
Yeah, there's so much. The oil industry is still very important. There will be firms that go bankrupt. I was surprised to see that Weatherford, which was a pretty large oil service and drilling company, they went bankrupt. I remember a couple of years ago hearing that they were shopping the company for a buyout at a premium, and then they just went bankrupt, I think, in the last month or so.
Yeah, it was recently, but that was no surprise to me. Weatherford's been in trouble for a long time. All the service companies are in trouble. When the price of oil collapsed in 2014, 2015, all of these service companies had to deeply discount all of their services way below. They have not recovered. And Weatherford happened to be a weak one. Look at Halliburton. Just look at these companies' stock. Look at their debt levels. It amazes me that Halliburton is not on the verge of where Weatherford is. Schlumberger, who's certainly, I think the financial powerhouse of the service industry. They've struggled. They've done it well. They've managed it well, but their stock price is way down. Their profits have disappointed. So the service industry, they can't extract more from companies than companies are capable of paying. And even though things are certainly better in the oil business as far as oil price goes today than they were certainly in early 2016, they're not great. Nobody is making any money at $53 or $54 a barrel or whatever we're at WTI. And nobody who's producing a well gets the benchmark price. As we discussed before, they get a wellhead price, which, depending on where they are, is less than WTI by at least a few dollars, if not $6, $7, or $8. So, take 55 has sort of been the price of WTI over the last month or so on average, and let's just say you subtract $5 from that to get the the wellhead price. I mean, everybody's losing money at $50 a barrel. Everybody is. Doesn't matter who they are. As a company, some of their wells, some of their properties may be breaking even. The best ones at $50. So everybody is suffering in the oil business right now. And don't believe anybody who says it's different than that. It's just that's just not true.
Well, the earnings for EOG, I think, recently are down, but they're still profitable. So I think a lot of their wells, they're making money. Maybe they're hedged. Did they hedge a lot of their oil production at higher prices then? Because they appear to be in a lot better shape.
Well, be careful. What measure are you talking about? I mean, if you're talking about, let's talk about something real basic like, capital expenditure over cash flow. EOG was cash flow negative in the second quarter, not hugely so. Of the 15 or 20 tight oil weighted companies that I follow, I think only 4 of them were cash flow positive in the second quarter of 2019. So, you can look at some measure and say, well, just looking at net income, maybe they looked okay, but what did they sell to get net income up? I mean, that's usually what happens. Or if like Pioneer, for instance, had a very favorable capex to cash flow. In other words, free cash flow. They were the best of all the companies that I follow. But look more carefully, and they did it by not drilling very many wells. So they got a good capex to cash flow ratio by cutting way back on the capex. Well, that may give you a good number this quarter, but it's not a very positive sign for the future that you're getting a good quarterly result by curtailing future profits. So you got to be really careful. And again, like with all things in energy, don't just read the headlines. Talk to somebody that actually understands how to go through a 10Q, which is the quarterly earnings report, and tell you, in fact, what's going on here. Why does this number look better than somebody else, or why does it look worse? What's going on in this company? Take a company like Concho. Concho is one of the better companies, a pure Permian Basin player, and yet, Concho took a giant hit on their share price when they announced second quarter earnings because they lost money. Well, what caused that? Well, they took a $900 million impairment on writing down reserves. Ouch. But, that doesn't, so that's a non-cash item that has a big effect on your balance sheet, but it's not cash in the current quarter. I'm not trying to say it's not important. It is important, but you got to know what you're doing, or else you can be misled by one number or another number. So again, be careful. Talk to somebody that actually knows what they're doing and can help you understand what does this really mean.
And if I could summarize a lot of what you just said for basically the whole interview, it's that the industry is having real problems growing production, especially at current oil prices. I think also I've heard from other people that the natural gas production, a lot of the natural gas producers that are producing shale gas are having even more problems with their economics than the oil producers right now.
Well, that's been true for many years, but, gas production has never been higher, and, it's grown something like 17 or 18 BCF a day since the beginning of 2017. But again, look at the growth rate. That's what we're really talking about here, Jason. I mean, the production of the United States, the production of tight oil plays, and the production of shale gas are all going up. What you're really saying, or what I understand you to be saying, is that the rate of growth is declining or slowing. And that's the issue. And so all of these companies, they've got to have a growth story to attract investors, and there really isn't a credible growth story. So that's a problem. But so it's a complicated situation. Bottom line truth is that most of these companies, the independents who created the so-called shale gas and tight oil revolution. I don't think it's a revolution, but that's another conversation.
You called it a retirement party. Yeah.
And if a retirement party if you call that a revolution, God bless it. I've never been to a retirement party where people were very jolly about it. But nonetheless, the point is that capital has gone elsewhere for a variety of reasons. That doesn't mean that there's no capital available to these companies, but it has been getting tighter and tighter for the last several years. It was never more available than when oil prices were $27 a barrel. Guess what? Buy low, sell high. You don't have to be a genius to figure that one out. Investors have figured out that, prices, every time they start to go up, they go down. And so the expectation has been adjusted. And most investors, if you say, I think oil's going to $100, they're going to laugh you out of the room. They're going to say, well, not based on any kind of empirical information. Seems like every time the price of WTI gets to 60, it crashes. And it's always $50 to $60. And most investors, for a variety of reasons, some of them are the global economy, as you mentioned, they just don't see a lot of expectation that that's going to change. So they're looking around, or they started looking around for better places to park their money. It's that simple. And by the way, a lot of that money has now gone into LNG export, which I think is an absolutely insane investment on the basis of the economics. But nonetheless, I mean, there's a startup export terminal in South Louisiana that raised $10 billion just in the last quarter. Okay, go figure. But the money doesn't go away. It moves around. And the money has gotten tighter and tighter from the oil space, and nobody wants to touch the natural gas space, but natural gas export, looking pretty good to some people. I can discuss that, but let's leave it alone for now.
And I believe, to add to your points there, that a lot of shale gas is being flared off. I think an enormous amount recently I heard of shale gas is being flared off compared to the past.
Well, there's an enormous amount of gas being flared. Most of that's being flared that's associated with oil. I mean, the Permian Basin is flaring 700 million cubic feet of gas a day. And
that's insane.
There's the only way to they can't. There's no gas. There's not enough gas pipeline to take away the gas. You can't put gas in a truck. You can put oil in a truck. So they're flaring the gas so that they can produce the oil, so they can get some money. And by the way, the state gets a severance tax on every barrel that's sold, and so it's in the state's interest to let them flare the gas. That's not a good thing for the environment, but that's the truth. And there will always be a couple of 100 million barrels a day, cubic feet of gas flared, because once they get all the pipelines going so that they don't have to waste the gas, they're still going to generate electricity on site to run the compressors, and that's going to be 100, 150, 200 million a day of, burning gas for a legitimate purpose, but it's still flaring gas, right? I mean, we flare gas to produce electricity right now. I mean, so again, you got to understand what you're talking about here.
So I've kept I've thank you very much for your time, Art, today. I've kept you for over an hour. I think you've given my listeners a lot of excellent analysis about the oil and gas market. Sorry, I didn't know. I thought I'd heard you talk about investing in oil wells. I assumed that they were shale wells. I guess they were regular conventional wells. So I apologize for that.
No problem.
Well, final question then. So cui bono, who benefits from this? Is it the oil refiners then? If oil prices stay at these levels or go lower, is it the oil refiners like your Valeros and those guys who are going to benefit from the better margins and the cheaper oil inputs?
Well, that goes up and down daily. And so, I mean, the crack spread is what it's called, the refinery margins. That's a function of the price of oil, the price of gasoline, and the price of diesel. And so, you know, generally, if oil prices are lower, you would think that refining margins will be better. But if it's an overall devaluation, as it was in 2014, and gasoline prices are very low and diesel prices are low, then refinery margins stink also. So again, you know, it's on a very, very high level, it's fair to say that low oil prices are probably better for refineries, but only if gasoline prices and diesel prices haven't dropped as low as oil prices, or proportionally as low. So who benefits from all of this? Well, the people who benefit are all those who own leases, who don't have to put a dime into the ground, and they get a percentage of the income or revenue from every barrel. All the people who have jobs related to producing and transporting oil and all of the services related to it, the people that own hotels and restaurants. I mean, the U.S. economy benefits from all of the economic activity around oil and gas a whole lot more than the percentage of capital that's actually spent in the oil and gas business. And by the way, back to the point I made earlier, if the United States is importing less oil today by several million barrels than it was in 2006 or 2007, that's more money that stays in the country and can be used by Americans to invest or to spend in the U.S. economy. So there's tremendous benefits to all of us by having a robust oil and natural gas industry in the United States. And I want to make sure that, you know, if I make comments that people perceive as negative about the economics or something, and I don't think I've said too much like that, I mean, oil business, that's the business I'm in, okay? I'm proud of the business I'm in, and it's good for the United States. There's no question about it. It's good for the economy.
Well, the lower oil prices, Art, I think also benefit the U.S. consumers. So you talked about the industry, the workers in the industry that are still producing the oil, transporting the oil. I think the consumer at the gas pump should have more discretionary income from the lower oil prices eventually.
Absolutely, they should. And again, it gets to being a balance, that when oil prices get too low, then companies start laying off people, they slow down drilling, and so a lot of people lose their employment. But, you know, but overall, the oil business has been very, very good to the U.S. economy ever since Colonel Drake drilled his first well in 1859, and that's true today.
So the refineries then, before we wrap up here, the refineries, they have to blend, correct me if I'm wrong about this, they made huge CapEx upgrades before the shale boom. So they were expecting to have to use heavy sour crude, right? So they made billions of dollars, and these are the Gulf of Mexico area, Gulf Coast refineries, and they made billions of dollars of CapEx upgrades to use heavy sour crude from Venezuela and maybe Canadian tar sands. And so now that we have the shale boom and they have lighter sweet oil from shale, now they have to blend it, right, with heavy sour, and that's how they get the better margins?
No, that's not true. Those refineries, when they were built 30 years ago or so, designed for heavier grades, sour grades of crude oil. It's the increased volume of the ultralight sweet oil that's causing a problem. That those refineries are not designed for large volumes of the light oil and the sweet oil, and so they can blend a certain amount of it. But the bottom line and the biggest problem with all this oil that comes from what people call shale is that it is super light, and I won't get into the details, but what that means is it's okay for making gasoline, which is an end product. It's pretty much worthless for making diesel. And diesel is the number one transportation fuel of the world. So if you're confused by the fact that people think that all this new source of oil is the greatest thing since sliced bread or whatever in the United States is kicking OPEC's ass and all of that, ask yourself why we're exporting so much of it and why we continue to import more than we export, because we can't use it. We can only use a certain amount of it because it doesn't make diesel. And there's no technology in the world that I'm aware of that can put a component into that oil that it doesn't have to begin with to allow you to make diesel from that oil. And that's why we're trying to send it to wherever, whoever will take it somewhere else in the world. And it's not a matter, it's not a simple matter of, we just need to put a few $1 billion into our refineries and then it's fine. No, you can't make diesel from most of it. If you can't make diesel, then it just isn't as useful as you'd like it to be. I'm not trying to say it's useless. What I'm saying is you can't make the primary transport fuel of the world from it, and that's a problem. That's why we're exporting it. I mean, anybody who thinks that this is the greatest thing in the world and, we're going to be energy independent, the newest pipeline out of the Permian that's going to come on stream in September goes straight from Midland to Corpus Christi. What's it going to do in Corpus Christi? They're going to send it straight overseas. None of that oil is ever going to see the light of day in an American consumer. Got to keep that in mind. Yep. This is really important. We're kicking it out of the country because we can't use it. Now, I did not know that. Maybe that's an overstatement that somebody's going to argue with, but at a high level, that is absolutely true.
Well, I think energy independence, given how dependent the global economy and the U.S. is on oil energy and how the U.S.'s oil production, like you said, I think energy independence is a pipe dream. I mean, it's been talked about by presidents, Republican and Democrat, since the 1970s. I think Gerald Ford might have been the first president to talk. Nixon or Gerald Ford was the first president to talk about energy. Yeah, Nixon. So it's been talked about by basically every single president since then. And if you go back and check the track record.
Let me interrupt you. There isn't a president, a senator, or a congressman that knows energy from, anywhere inside, his own hat. These guys, and this is a statement of fact. This is not a prejudiced statement. These guys know zero about energy. I know that because I've talked to them in their offices. They know nothing. And when you said earlier that Democrats favor renewables and Republicans favor fossil fuels, I'm not sure I agree with that, but I would say that whenever people who don't know anything pick winners and losers, the losers are the American people. And so whether it's, the solar crap that Obama wanted to put all of our taxpayer money into, that was a bust. Whether it's ethanol that, George W. Bush wanted, that's a bust. Whenever the government gets involved with energy, we, the people, lose because they don't know enough about it. The reason the Federal Reserve was formed because after a couple of economic failures in the first part of the 20th century, people said, get responsibility for the money supply out of the damn politicians and create a group of people that actually know something about economics, banking, and finance. And that's the Federal Reserve. And we can have all kinds of arguments about whether they're doing a good job or a bad job, but the American people decided anybody could do a better job than the U.S. Congress. And I would say I'm not advocating that we form a Federal Reserve Board of oil and gas, but I'm saying that anybody could do a better job of it than politicians, period. It's a complicated subject, and people who only know a little bit, you know, I mean, this is the Dunning-Kruger effect. You know, you sit on top of Mount Stupid when you know a little bit. The more you learn, the more humble you become about all the things that you thought were true and the mistakes you made. So, and you know, we consistently put people in positions of Secretary of Energy who have zero experience in oil and gas. And I'm not saying that's wrong. It's just the way it is. They're political appointments. Most of the secretaries of energy have been people who are nuclear physicists, theoretical physicists. Maybe they know something about nuclear. That's great. They don't know anything about oil and gas. Rick Perry is the current Secretary of Energy. He's from Texas. You know, it's an oil-producing state. He doesn't know anything about oil and gas. Energy is a very complex subject, and I don't think anybody should believe what they read in the paper or hear on cable news other than on a very high level, a superficial level. And if you want to know more about investing in energy, if you want to know more about policy on energy, talk to somebody who understands that complexity, whoever that is.
Well, I think you provide a lot of great information for free, Art, on your website and on your Twitter. You're always linking to studies and blog articles that are very thought-provoking about the oil industry.
And you can find me there at artberman.com or at AEBerman12 on Twitter. You know, there's always something out there, and like you say, it's free. You know, there's no paywalls. There's nothing there to hook you. So, you know, go out there, and if you like what you see, you can find a way to contact me and sure you're working on. But that's not why I put it out there. It's there for free.
Well, we live in very interesting times, don't we? China just announced today that what they're going to put a 10% import tax, an additional 10% import tax on American oil imports into China. So we'll see what happens with that. The markets were not responding. That probably played a part, too, in why the WTI price is down besides just the Trump tweet.
Absolutely. Yeah, it all fits together somehow. It just takes a lot of knowledge and experience to understand how it fits. And sometimes it's not clear, but there you go. So, yeah, it's been great talking to you, and hopefully we'll have more of these discussions in the future, Jason.
I look forward to it very much. Thank you again for your time, Art, and my listeners, I think, will get a lot of value from this. So the bottom line, like you said, is that the project economics for a lot of these shale companies is around $60 per barrel. So right now, a lot of them are not cash flow positive.
Correct.